like to introduce the next panel, which is going to be on digital banking, digital investment banking. What is the future? What have we seen in the past few years as we continue the follow-on panel from 2023, which is where we first addressed this issue. So I would like to welcome back to the program Chris Richardson, Andreas Spillman, Lars Rottweiler, Brian Anderson, and a new entrant in Asa Siegel. So I'm going to turn it to you, Chris. Why don't you give us an introduction about you, and let's take it from there.
Sure. Thanks, Anand. I am Chris Richardson. I'm the CEO of IDAP Global. We're a London-based investment advisory and strategic advisory firm. And the services we provide, we'd like to sort of roll up and collectively call digital investment banking. Really anything that a classic investment bank does, so not retail banking, not that sort of thing, are the services we provide. And we started off doing this as the world's first entirely end-to-end. In fact, we issued the world's first fully digital bond. And one might ask, okay, so what? Why do you do digital? Why do we care? And in our case, the answer was the same reason that anything goes digital, right? It's not that we're going to go out there and compete with Barclays and Goldman. It's that by being fully digital and having our own infrastructure and our own sort of back end all the way from KYC, AML up through issuance, be digital, we're able to do things at a lower cost. And being able to do things at a lower cost, we're able to offer opportunities that the larger banks, the traditional banks, can't do. And what that really means is that we can do offerings sort of in the 10 to 100 million range and work with mid-sized private enterprises across a variety of functions, from private equity, private credit, hybrid, mergers and acquisition, all the things you normally expect from an investment bank, but focused on those really mid-sized companies that are the legitimate drivers of the global economy. Yeah, kind of who we are.
Thank you, Chris. I'm going to switch it over to Andreas. Andreas, please give us an introduction about you.
Yes, thanks, Anand. My name is Andreas Spillman. I'm a partner of Swire Patent Box here seated in Frankfurt, and I provide corporate finance, financial regulatory, bank regulatory, and other issues. And what I would like to do to talk a little bit about the regulatory framework for digital banks, because this is quite important. It's very complex, and it's different in the different jurisdictions. So, and even so, the term digital bank has been used in many senses confusingly for services provided by traditional banks through digital banking and digital channels, like providing. Sometimes it's used for financial services such as money issuers and other digital financial services. But this is not digital banking. This is something different. Probably would fall under the payment service provision or other terms. Defining characteristic distinguishing of digital banks comes more from traditional commercial banks. It's a delivery of financial services primarily through virtual channels. So in most cases, the regulators will ask for a typical banking license, but the services is not provided in-house by the banks. It's provided on virtual channels. This is a very, very important distinguish between other service providers in the market. Most jurisdictions that define digital banks allow for a limited physical presence, but beyond their main place of business. But in most cases, the regulation completely bars digital banks from having physical points of business with customers. And furthermore, digital banks, they provide, of course, more services than other fintech companies, which are very focused, maybe in most cases, on payment services. In digital banks replicate in a large degree the role played by traditional banks in the economy, providing a wide range of banking products and services, but just relying on digital distribution channels. This is, in my opinion, the most important aspect. And they provide viable options, providing enhanced and targeted products and services to more consumer segments compared with other types of digital financial services providers at a lower cost, of course, based on in comparison to traditional banks, which has more employees and they have to pay rent, they have to pay labor costs. And this is a big advantage of digital banks, which are more cost sensitive. And in addition, the lower cost base and wider geographical reach make digital banks significantly suitable to deliver modern financial services in comparison to traditional services. And these features should be considered by regulators in the future when developing policy regarding digital banks in the context of promoting financial inclusion. So, and as everybody knows, the industry is evolving and digital banks are adopting different business models, which characteristic that set them apart from traditional banks and other specialized digital financial providers. And while the operational model of digital banks provides opportunities to deepen financial inclusion, it also presents more inherent regulatory concerns. And I could, later on I will go in more details, but this is probably just to give you a brief overview how the market regulation is.
No, thank you so much, Andreas. You know, you're absolutely right, and I think you've hit on our next panelist's goals, which is financial inclusion by creating more and more digital banking services, especially in the global south. So with that, let me introduce Lars Rottweiler. Lars, if you could talk a little bit about your platform and yourself and tell us what you're doing.
So mBank, provider for as a service, which goes quite far. We do banking solutions. We also do obviously the cookie cutter of banks. So we have the IT, we have the back office, whatever you need to operate a bank. And on top of it, we have the banking license as a sponsor model out of the US, Eurozone, UK, and Switzerland. And we have today also we have also clients that utilize their own banking license, right? And it goes from as far as from Tonga, where the sun is rising, all the way to Honolulu, where the sun is setting. We have really a good number of clients all around. And our services include a lot of digital processes, of course, digital banking. What Andreas just said, I think that's completely acknowledged, and I agree with him. We go a bit further when it comes to digital asset management, tokenization as a model. We offer it outside of the US. US is restricted right now still a little bit when it comes to digital currencies and digital assets, but we do it outside quite successful, where we talk assets. We do it for clients like soccer clubs, football clubs. We do tokenization of their players, athletes. We see stadium enhancements, which are tokenized and then cross-sold over the banking platform. So we see real estate, so quite far actually how we see the market of digital assets. And with this, we have not only the platform, let's say, for the digital banking for retail, consumer, and corporate clients, but we also look inside this this model of what comes next when it comes to asset management and tokenization. We hope for the Trump administration that we get a little bit a chance to put this market in action. We are prepared for it and have the right tools for it.
Thank you, Lars. Yeah, no, absolutely. And I think that as the world moves, one of the big differences we have in today's conversation is when we had this conversation in 2023 and previously in 2021, I think, we were not sure about real-world asset tokenization. We were not sure about how the entire crypto side of it would work. We were not sure about how smart contracts would pan out. So there's been a significant improvement, and with that, I'd like to introduce Brian Anderson. Brian is on the RWA side of it. So Brian, why don't you talk a little bit about what you're doing with Raise?
Thank you so much. Yeah, honored to be with you guys. So yeah, we sit on a different side here, but we greatly depend on everyone here on the phone or everyone here on the Zoom, which is digital banks and the integration with those kind of services. So we're technically a enterprise grade tokenization software platform. We ultimately want to be the back office to enable the onboarding of digital assets and the securitization of those assets. A lot of people don't realize that although someone can spin up a token, I think we just all experienced this in the last week or so, someone can launch a token in a matter of minutes and spend very little money. So tokenization has now been commoditized from a software perspective. But once you launch that, now what? And so there is a significant infrastructure upgrade that has to happen over the next 10 years. So where we sit is we really believe that the private sector, private funds, there's, I don't know, somewhere around 50,000 plus funds just in the United States, for example, that will want to digitize. They want to bring their assets on board, on chain, along with hundreds of thousands of corporations. And so we are niching in and a provider of turnkey end-to-end asset tokenization. Compliance has to be built in from day one. We've really been waiting for this moment. Nothing has changed from December to January. Nothing. No regulatory changes have happened. All of the same kind of rules around securities are still in place, although changes may happen and should happen around digital assets. We know that most companies, most funds are very hesitant still. And one of the biggest issues is they're hesitant because, great, I tokenize. Have I just added more friction to the transaction? And the answer is absolutely, you have. And so we want to exist initially to remove that friction and ensure that it is very possible for someone to tokenize, but also integrate with the existing infrastructure, which takes all of us to integrate together. Our primary focus as well is really on private funds, private credit, real estate, even insurance being tokenized, anything that falls under real world assets. But also, let's not forget about equity. Equity and cap tables will be tokenized, and they already are. And so anything that categorizes as an asset. So we, last thing I'll say is we're greatly dependent on the flow of funds, right? The buy side and the sell side. And that is, I see as one of the greatest opportunities right now, is if we can unlock that as an industry, then then people can actually experience what we all experience in crypto, which is the ease and flow of funds. And that's not always a good thing. But if we can take advantage of that as an industry, combined with the tokenization aspect of assets, then I think we'll see a massive influx of adoption.
Thank you, Brian. Lisa, coming to tokenization and that side of it. So let's hear from you.
Wonderful, Anand. Great moment to join in the conversation as I am the founding partner and chief investment officer for Ilana, which has a strict focus, and where my expertise lies is with regards to the application of blockchain technology in servicing the fundamental needs of the regulated global financial system. So the abundance of knowledge already shared from this panel kind of taps into the area of my focus, which is what are the roles that public blockchains play in this process, and my focus in them as a primary investment vehicle for a long-term growth strategy. And I think fundamentally, when we look at this iteration of the internet, as I like to view it, the digitization of money and value, and the tremendous opportunities that presents, as long right along with the challenges, but the opportunities for this access to global interconnectedness, where we reference the global south, this quick ability for so many members of the unbanked population to join the global financial system. And when we look at that evolution in the moment that we're in, Lars referenced the incoming administration and the changes, the regulatory framework is going to go through, in my opinion, a very transformative shift, as most members of G20 nations already are far ahead of the United States, the largest financial market, with regards to the passage and implementation of comprehensive regulation for the industry. And far apart from just the president, it is the sweeping victories by members of both the House and the Senate that are pro-crypto innovation, and the shift being an actual legislation being implemented in the United States, as opposed to the regulation by enforcement kind of stance of the previous administration, upheld by Gary Gensler at the SEC. So in practical application, what I see is so much development, testing, and building out of the infrastructure, as was Lars alluded to, has been taking place for years. We just saw Brian Moynihan from Davos yesterday in an interview, or I think it was yesterday or the day before, in an interview, share how Bank of America has hundreds of patents in blockchain technology, and should the regulatory framework switch, they will be immediately incorporating instant settlement into their transaction flows. So the climate for digital banking, and I think the opportunity is twofold in terms of digital banks and new players in the space, like Brian was alluding to, and Chris, need to be at the forefront of integrating this technology to provide benefits for specific populations and communities, and define niches, because the largest players in the traditional banking industry are going to become more involved, right? When you look at things like the SAB 121 kind of imminent repeal in the United States, which will finally give these larger banking institutions the ability to hold crypto as a principal without it being a negative on their balance sheet. So I think it's quite a fascinating moment, and I think we're looking at potentially explosive growth in terms of the implementation and adoption of tokenization, as Chris and Brian alluded to. And what that means in my focus is ultimately that interconnectedness of the global markets is dependent upon public blockchains. And I just don't think people most in the investment community understand that, again, kind of in this iteration of the Internet of Money and Value, the investment opportunity that taking positions in public blockchains through their native crypto represents over a long-term thesis in where we are in the adoption curve.
Thank you so much, Asa. I appreciate your input in this. We are just adding one more panelist, and she will be on shortly. But in the meantime, I wanted to continue this discussion, since what I'm hearing at this point is that a lot of what is happening globally is maybe escalated with U.S. regulatory reform. But at the same time, we have very defined reform or defined regulations in the European Union. We have defined regulations in the BRICS countries, and we have defined regulations in most of the global north. So, keeping aside what may happen, with the new administration in the United States, let's look at more of how does this work on both directions. One is on attracting family offices, wealth managers, and traditional investment banks. But at the same time, on the other side, which is the niche markets, which are undocumented, underserved or unserved communities, and whether it's in the US or it's in the global South. These are the two areas that I'd like an opinion on, and we'll start with you, Andreas.
Okay, thanks so much, Anna. First of all, I like to mention that there's a kind of regulatory arbitrage, and what's the best place to go in the future. As I told you, the regulatory framework is in the region quite different. In Europe, we have this more specific regulation like the Payment Service Directive. And you have, in addition, you have data protection regulations and so forth. But this everything is to protect the banking industry from the digital banks. So you have combined regulation, and a digital bank has to provide similar the management and has to provide similar expertise in the banking industry. And the setup has to be very similar to traditional banks. In the US, it's a little bit different. The regulatory frame is, of course, to protect the consumers, but it will promote technical incentives. So that's, in my opinion, the reason where it's much easier in the US to attract tech companies or other family offices maybe to invest if their money can be secured and if there's any, of course, a return on investment. In Asia, we have a different regime. It's more liberal, especially in China, because they want to inform digital currency and to control the financial stability in a different way. And they promote the setup of digital banks. And the same is applying, in my opinion, in Latin America, where all the setup of the digital banks is supported by the regulators and by the supervisory authorities. This might be good for the further discussion.
Oh, excellent. Brian, when we look at what are the challenges ahead, one of the challenges always has been in the US is to attract family offices, attract institutional investors. How are you tackling this problem?
Yeah, great question. I wanted to state something along those lines, but also mention that, I think along the lines of what was asked earlier is we see one of the great opportunities, but not also one of the challenges too, is that we think a great demand for this, and we're talking to a lot of potential customers and current customers to try to tackle this, is that tokenization has an appearance and to some degree a reality of fast tracking alternative financing when you cannot get financing in other places, whether it be a mining operation in South Africa or a real estate development in Miami, or whatever it may be. It opens up the door to a much more affordable and much faster way to be able to access funds. On the flip side of that, who's going to invest in that, right? That's always been the problem with tokenization, or one of the biggest problems. But I think you're going to see a massive shift go very fast, not just because of the administration, but because, or the changes in the political environment in the US, but because once there's announcements happening, and there already are, of people doing this, it started a year ago with BlackRock, then they're going to start dabbling in, and they're going to realize that you can invest in shorter term in, whether it's a lending protocol, like a DeFi protocol that they're participating in, or lending money to a mining operation, or investing in a real estate development. The novel investment structures that you can do with tokenization are mind-blowing. I always tell someone, if you can put it in a legal agreement, we can tokenize it. And people don't realize how powerful that statement is. And what it means is I'm not a finance whiz, okay? But I have seen some incredibly creative and complicated structures in traditional finance that I don't understand. I'd have to read the agreement 27 times to fully wrap my mind around it. But when you put it into a digital format, you have just created an onboarding opportunity for investors that you can't access today. And it's simply because the delivery of the security and the instrument is very different than it was before.
That's a really interesting thing. And yes, Lars, I was coming right to you with that.
I want to add something to it because
that's a perfect segue for Lars.
An example, so to what Brian said, that's exactly what happens, right? We create secondary trading markets with this. So, and come back to the example I gave to the soccer club in Europe we addressing here, right? They built a digital bank with us for the fans. The fans have their loyalty, the credit card, debit cards with their favorite player on it. But now comes the tokenization part of it. So they think about making the stadium enhancement, collecting money. Instead of looking for donations and charity, they can now sell a share to their fans in the banking app. So fans can buy a share of their new stadium, which quite likely happens. Second, for new players, think about a new player comes in, they collect money, 20, 30 million for a new player. You collect it as a digital asset. The charm it is kind of a trading game inside your banking app. So it's not happening on a stock exchange, it's happening directly on the point of your mobile phone. But you have a digital share of your player. If it's successful, value goes up. If it's not successful, you might lose it right before you can sell it again. I think that's so applicable markets for it. And I myself live in Dubai. Many real estates are tokenized nowadays, at least from the contractual perspective that we see collaterals, now digital collaterals. I think that just makes life easier. You don't need to have a notary service anymore in front. Buyer seller can be abroad, don't even have to come for getting attestate. Everything happens digital on the platform. Super use case, makes life easier. And I think with those ones, which makes life easier, we create secondary markets. Then what Brian and Aisha said, that we get the legal framework around in the US, which is the biggest market and probably gives the biggest push later on. Everyone looks there. I think then we are see a really revolution in the next 24 months coming in front of us.
Chris, your continuation to this conversation.
So I think the points that everybody's made are excellent. And from the perspective of our audience, I think it's really critical to think about this at least as two or three different things. And there's a difference between public blockchain and public tokens, private tokens, and something that is digitized, whether it is privatized, whether it is tokenized or not. So there are those three differences. And then there's am I investing in digital infrastructure? Am I investing in buying actual coins on a public blockchain that may or may not have anything to do with tokenization of a real asset? Am I investing in one of these companies that is supporting sort of the retail adoption of faster, easier, more transparent transactions, cross international transactions, all the benefits you get from public tokens? Or am I investing in an asset? And I think back to your question that you just asked about, okay, so how do we attract and appeal to institutional investors and family offices? The reality is they don't care that anything is digital, and nor should they, right? They care that they're making a good investment. And in fact, I think it was Brian who said earlier that, yeah, the transaction cost of doing stuff digital is higher. And their transaction cost of doing family office size deals and individual deals is already very high. And the last thing they want is an additional hurdle and have to try and understand every new token is a new contract that's 100 pages only. Great, now it's digitized, except like, what does that mean? And how do we negotiate individually? And you don't, because each one's unique. So I think from the family office perspective and the institutional investor perspective, yes, there is an opportunity to invest in these infrastructures because they will be hugely meaningful to retail over the next 10, 20 years as we move to that fully digital process. But there's also the question of, okay, great. Do I, as a family office, want to buy a token on a public blockchain? Probably the answer is never yes, right? Everybody thinks about privacy, but privacy is not the same thing as privacy, right? Public blockchains are public. And so everybody has access to that record. And while there's already tremendous hurdles around going through the KYC, the anti-money laundering stuff in the traditional finance world, at least when you've completed that, your holdings, your investments are still private. And the minute you move that to a public blockchain, that's not true anymore. And you can still obfuscate stuff, you can make it hard, but fundamentally, the whole point is that it is public and verifiable by anybody. And so I think from the how do we appeal to these people perspective, there's a different tack you take if it's, hey, I'm a family office and I want to invest in the digital world in the future of these things, or I'm a family office and I want to invest in good deals. And if digital makes that cheaper, easier, faster for me, great, let's do that. And they're different marketing messages and different audiences even slightly.
Lisa, yeah, coming right to you. You need to unmute. And Asa, if you have a screen in the background which is also playing, it'll cut back the echo if you lower that.
Okay, thank you. I'm just going to dive in because just knowing that nobody else is experiencing the echo is what's important. I want to comment on a couple of things that Chris shared and kind of add some of my perspective to it. So when we look at this relationship between private and public blockchains, and a lot of the confusion that Chris detailed around understanding the distinctions of what one is investing in and understanding where digitization and being digital comes in. There are two major points I want to make. One is, again, where we are on the adoption curve of the tech and how quickly that might change. Because the friction that Brian mentioned that exists right now and that he's troubleshooting, which is extremely valuable, is because there's still this fiat to digital translation that needs to take place. It's important to understand that, like, when we look at where we're going, there is this vision. I'll quote Augustine Carstens, the general manager of the Bank of International Settlements, who wrote the Finternet for the future vision of the global financial system. And what he says is that the vision includes that anyone, anywhere, will be able to transact any asset to anyone else, anywhere in the world, instantaneously. And so we are at a very clunky phase where we're doing an integration between the old world of a fiat, non-digital world, converting into a digital world. But if we look at where we're going, it's all encompassing because we're looking at the retail portion of that in stable coins, in different assets being tokenized bank deposits. And we're also seeing it on the wholesale level, with nations rapidly developing their wholesale central bank digital currencies. So that meaning actually money and value in moving forward are going to become more predominantly digitally native, and it will actually be the opposite. Is where does cash and non-digital assets fit into that financial system? But I wanted to make one further distinction about the relationship between private and public. And I'll take the example of Franklin Templeton and Jenny Johnson sharing about how they worked on their initial tokenization of a money market fund. And she details that they built out the client relationship structure on chain, and that incorporated their private chain, and then integration with transactions taking place on a public blockchain. And I think it's very important to realize that I disagree with Chris when he says why people would want to invest in public tokens of public blockchains, because again, I think that's where people miss a big part of this boat here, is that if you don't have public blockchains, you have a bunch of closed systems, which are much more akin to if you only had Yahoo or you had Google email, and you could only send email to another Google email member or another Yahoo email member. If you have closed private blockchains without public blockchains, you don't have global interoperable markets. And so what people don't see is that the way that you invest in those global interoperable markets is solely through acquiring the crypto that is native to them, which is required to secure and or transact on those networks. So the notion that you would never want to invest in the crypto of a public blockchain is something that is completely the antithesis of the way that I see the future folding out from an investment perspective. And I just wanted to highlight that, because if you don't have public blockchains, you don't have a digital global financial system.
Yeah,
Brian,
I saw Brian raise his hand, but before I just want to jump in and say I totally agree that the public blockchains are critical to a large part of the international commerce association with this, and there's nothing wrong with cryptocurrency qua cryptocurrency. My point was more about the kinds of assets that family offices want to hold. Totally agree with everything you said, Asa.
Yeah,
and I'm just going to add one quick. Oh, go ahead.
Just from a regulatory standpoint, regulators, they don't care so much about the technique. They don't give you a license if you use blockchain or other technique. You have to just explain it, but that's not one of the main factors to get a license. So blockchain is fine if you can do everything under blockchain, and there are no regulatory issues because you cannot provide consumers with the products you propose or you want to provide. So that's the only concern they have, but the technique is not the main concern, in my opinion, and what I found from European Central Bank documentation. And another point for digital banks, for family offices or other investors to invest in digital banks, they are public. So all the information about the investors are public. And in my opinion, for some family offices or some investors, it's a little bit problematic because they don't want to be with all the names, with all the underlying companies being public and shown in all the registers. So this might be a big hurdle for
Yeah, no, Andres, I think that's that I think was Chris's point, and I think that's my understanding of it as well from family office discussions, is saying that does a family office want somebody to know their compartment in Liechtenstein? No. So they don't want that information on a public blockchain. So there is some work that needs to be done here to be able to bridge that that very private offices are always very confidential. They will never discuss their investments. They will never discuss anything to do with what they have. And so the concept of it being on a public blockchain becomes very problematic for them. And of course, that doesn't mean that that won't change in the future, but certainly there needs to be some form of confidentiality built into the system. But then that takes away, as Chris so rightfully said, the whole point of a blockchain.
Not only blockchain, it takes away the investment into a digital bank, which needs a license, and they will check all the investors, and the investors are all public. So this reduces. You can be a big tech company and they don't care, you invest. But if you're a family office and you invest in a digital bank and will be public and all the names of the owners will be public, that's a point maybe they don't want to see.
Especially with rules around beneficial ownership and all of that, certainly that becomes very problematic for
transparency register and so forth.
Exactly. So so that's I think Asa, that's what I think we were coming to. Lars, what is your thought process on this, since we haven't heard from you for a little bit?
Well, Brian still raised the hand before, and we think we completely skipped him. So sorry for that.
Sorry.
But I completely agree with what Andreas said. I mean, we've seen this too, right? That the market, of course, is the dominating factor, right? The license from where the banking license is granted. And most of our BaaS clients are based out of the US, while the rest of the world, we mostly have then own licenses. And those markets where you think are very liberal, like Caribbean or UAE, whatever, they're actually the most restricted. And we've seen very much openness in Switzerland and in UK, even Eurozone. We have different countries where very supportive when it comes to crypto tokenization, right? But I completely agree with what Andreas says. This is the key is the acceptance of this of the regulator towards the digital bank, which is the interface then later to give access to all those trading possibilities, right? So I think we might see probably more secondary trading markets for more assets, but then for me the question is it just crypto, which is still a form of gambling for me, or Ponzi scheme, while there's a tangible asset on the other side. Tangible assets needs a different regulations, needs a security. It's a custody holder which is completely audited and traced. So I think that's the key differentiation. Do we do cryptos or do we do functional assets, right?
Yeah, Brian.
I was just going to add something earlier we were talking about, which is, how are family offices going to participate in this, or are they, or what's going to draw them in? And I'll just simply kind of throw this out there. I think we all know this, but something like by 2045 or 2050, 80% of the wealth is going to transfer, to millennials and Gen X and the digital native generation that comes after that. And it's very important to understand that digital native generation is very different. I remember when we didn't have internet you know, and so it's a really important point, because folks that are moving their new money into family offices and moving their new money into different asset classes, they're thinking a lot different than my parents thought and the previous generation. And so it's very important that traditional sources of capital really understand how this is going to affect how people move their money into things, because liquidity isn't a word that a millennial thinks about. They just know they can get in and out of things very quickly compared to the previous generation, and that for them is just normal. And I think that's just an important point that can't be missed.
Yeah, and I think you're absolutely right. And I think Asa was pointing towards that market largely, as we look at, you know, kind of the family office structures globally. You know, U.S. family offices are very distinct in their behaviors and their structure and in their setup. Whereas in a traditional Swiss family office, you know, we are looking at a full infrastructure with a chief financial officer, a chief you know, investment officer, you know, and there's $1 billion in assets or something like this, or €1 billion in assets. When we talk about family offices in the U.S., we are talking about a little bit different structures. Isn't that correct, Asa?
Yes, Anand. And I think that when we look at the kind of flexibility and the dynamic nature of, you know, for lack of a better word, the autonomy in decision making and lack of burdens that family offices have in terms of the decisions and the actions that they can take in investment, it's a great point, because I think that family offices are uniquely positioned right now in investment in every capacity that we're discussing here, right? So into digital banks, into the way that they think this technology is going to be adopted from, as Chris really astutely said, understanding all of those different capacities, companies that are building on top of digital technologies, blockchain networks and how you invest in those networks that are scaling this, and banks, you know, innovative investment banks, right? They have an opportunity, and they really actually have a closing window on that, in the sense of when we talk about the pluses of regulation coming in, you're also going to get a lot more competition when those barriers to entry for taking investment action are lowered and or removed, right, for a lot of bigger players in institutional allocation. So I just think it's a tremendous point you're making on that. Family offices, you know, oftentimes they're so used to everybody coming to them, like, you know, like they're just getting pitched. But I think family offices need to actually switch really quickly here. And I think to the point about Brian talking about the future and youth and the sophistication of a lot of younger family office managers, they're kind of at the forefront now, I think, of being more proactive and seeing this as a huge opportunity for them to take kind of front run a lot of other institutional allocators that are hamstrung right now in terms of the actions that they can take.
Yeah, no, absolutely, and I think that brings up you know, the next part of it is, do organizations such as Brian, yours, or Chris, yours, and Lars, yours as well, do you become book runners? Do you actually run the entire transaction? Are you underwriting it? Are you providing that security to the investor of saying, okay, I know that IDAP or Raise is going to do sufficient diligence for this this transaction, because there's an associated risk, right, in platforms.
Well, I'll comment on that by saying I can't speak for everyone else in the space, but we purposely approach this from the beginning to say issuers on the private side, issuers need to remain issuers. They need to remain in charge of their securities, and blockchain actually empowers that at a 10x level. Like, you can actually, you know, when you start getting into the technical aspects of decentralized custodial wallets and decentralized transfer of funds and things like that, now all of a sudden you can do things and remain private and remain in control of all of these things, but actually do it safer. And the transparency doesn't come in revealing who your investors are or private financial transactions in that regard that need to remain private. Instead, they come in transparency from an auditability perspective, is what actually occurred at the detailed level, almost like taking your enterprise level books or QuickBooks, and putting it on blockchain where people can see what's going on, if they need to check on it, but they can't tell who it is and why it may have occurred. But the auditability is profound. That's why when people think they can avoid taxes in Bitcoin, it's hilarious. Not going to happen,
Yeah.
when they, and so, I would just say that I think we thought about that from the very beginning, is let's empower this technology and give it to the companies, but give them the ability to adapt it versus try to add another middle layer to it, because that's not going to solve anything.
Right. The reason I bring that up, and I'm going to switch over to Chris on this, Chris, is because, one of the problems that has happened is, or no, not one of the problems, but one of the gaps that has developed is the fact that there is a transaction size for which basically there's no investment bank, and or the cost is prohibitive. So even if you got an investment bank to raise you $2 million, if you have to pay $200,000 as diligence fees, this doesn't make sense anymore. Chris, you want to take that, and then we'll go around in a circle.
Yeah, I mean, I think that's actually kind of why we're in existence, right? Is that there is this asset class from an investor's perspective of what we would call mid-market private enterprises, where the deal size is just too small for a traditional investment bank to handle it. And the nature of the investment is too weird for a traditional commercial bank to handle it, or a traditional retail bank to handle it. And so there is some sort of investment banking requirement there. And to back to your original question about who is doing the issuance, who's doing the underwriting, that's the main value we provide, is that kind of every deal we do is different. And sometimes we will underwrite a deal if that makes sense for that particular deal. Sometimes our client is an issuer. Sometimes we'll be the issuer if we're going to go out to sort of the mass affluent of the world. But for the vast majority of our transactions, dealing with the family offices, writing smaller checks, sort of the a couple million in individual investments where it's adding up to maybe 10, 20, as much as 50 million in a total deal, those sorts of deals, our value is in providing the structuring and the due diligence to make it easier for them to assess it. And yeah, if you've never worked with us before, you're going to want to deep dive on the first deal, maybe the first 2 or 3 deals, and really say, okay, yeah, we now believe in Chris and IDEP. We know what they're doing. We get it, so that you can move more quickly in and out of deals in the future. That's exactly what we're all about, is how do we remove friction for investing into opportunities that provide a high enough reward at a low enough risk to be appealing. And we think where those exist is really emerging industries, emerging markets. And by definition of that emergence, nobody's an expert. Like it's hard for somebody to say, oh yeah, I want to go invest in soybeans. I get soybeans, but okay, do I want to go invest in Brazil nuts grown in Peru? Yeah, what do I know about that, right? So that's the value we provide, is to ensure that due diligence is done and present it in a clear, easy to understand, replicable fashion, so that our LPs can quickly make these decisions and come into deals. And I don't want to ramble on too long here, but to sort of hit on that point, I just use the phrase LP. We actually don't run any funds. So we don't have limited partners in the traditional sense that come into a fund where we make your investment decisions for you. From our perspective, because these deals are so niche and so different, we try and package them up in a way that our asset class is appealing to a certain investor class, and then accumulate partners on the investment side who are interested in those sorts of things, whether it's alternative energy, or whether it's water systems, whether it's whatever your investment thing is that you are interested in doing. If we're involved in that, we're going to come to you and say, on every one of these deals, okay, here's an alternative energy investment, here's an alternative energy investment, and they're all going to be packaged the same, but you're going to get to make the individual choice rather than writing your money off to somebody else who's just going to manage it for you, maybe not the way you want.
Got it. Andreas, you had a question, and then Lars, you.
Yeah, just from a lawyer perspective, in those transactions mostly, in many transactions I've seen and advised as a lawyer, especially if they're tokenized, there are so many legal issues. First of all, sometimes we have legal issues with the issuer. Is there any regulation for the issuer? Second, is the token regarded as security? Does it have any security aspects? And thirdly, is the underwriter, does he have the respective license? Does he has to do AML, KYC? So from a perspective of a lawyer, there's a lot of work, which is good. And nevertheless, it's a high burden for everyone.
Yeah, no, that makes sense, Lars.
Well, I want to add to what Chris said. I see it from the tech space. I trust that AI will make a big role on how to select the right asset class and how to make an investment decision. We have, for example, a tool for SME, small medium enterprise loan approval underwriting tool, and it brings down this whole process to get a corporate loan to minutes, to 5 minutes, 6 minutes. And instead of let's have this long assessment of 2, 3, 4 weeks before you can get a loan for your new office building. So I think we see similar trends now coming for this digital assets too, for sure. Where do I put my money in, right? And what's my risk appetite? And then the AI will come with a conclusion.
Yeah, perfect. Asa.
Especially for the smaller buckets, which Chris said, which might be not addressable for those offices.
For the large investment banks. Yeah, no, that makes sense.
Yeah, thank you, Anand. I think the kind of final contribution I can just add there, flowing with the panel, is that when we're looking at those asset classes, we are looking at a monumental transition right now in terms of a distinction as well. Lars kind of referenced the crypto that seems to dominate the headlines, which is we look at crypto as this speculative wild gamble, which there is so much of it. Brian highlighted and alluded to anyone, including the president of a nation, can launch a meme coin and have it be a very manipulative, Ponzi scheme type structure, which should be called out. And
yeah, okay.
Yeah, but just we don't need to get into politics. I'm talking about the structure. We don't need to talk about who's doing it. But what I want to just add, kind of in conclusion, when we talk about this asset classes and allocations, I do want to just reiterate that the biggest thing I think people are missing right now is the other side of crypto, which is that the entirety of the global financial system is heading in the direction of running on crypto rails, and public blockchains are crypto rails, and crypto that is utility driven. And again, my focus is blockchains that have been working for years on regulatory compliance, on servicing the fundamental needs of removing friction for the regulated financial system itself. That is the future, in my opinion, of where crypto will have its redemption and will actually be viewed as a kind of a crown jewel as a new asset class because of its vital role that it plays in kind of the fundamental activity of the global financial markets. So that's just
I agree with you. So as a closing thought, what I will say is that, what I'm understanding from this panel and from what I'm going to take as a bold prediction from this panel is that we have taken quantum leaps from 21 to 23 to 23 to 25, and that within the next 5 to 10 years, not only will we see the acceptance of real-world asset-backed tokens and smart contracts that will change the way that family offices behave, to change the way that investors behave, change the way that even retail investors behave, because we are seeing a confluence of retail banking, traditional corporate banking, traditional private banking coming into more and more the digital realm anyway. Yes. More and more, we don't see, there was a time from the 90s when every branch everywhere was full of people. Today, there are no people in banks because, especially with the new generations, if they have to go to a bank, then they want to be paid to do that. They don't want to actually spend their time to go to a actual branch, especially in the U.S. and in much of the global North. And I think that confluence of traditional banks, none of the banks want to be in the retail business. They're basically just to maintain their licenses. So the sooner they can get rid of that, and the sooner they can move into the digital realm, the sooner, and that transition has to happen. So I think that the confluence that we're talking about here between the two sides, with digital banking as a consumer banking, private banking, et cetera, traditional banking segment, and then adding into it the asset management side of it, this becomes very interesting. And whether it's, as Chris said, a mid-tier transaction for as an investment bank, or as Brian said, doing an issuer-derived transaction on their platform, or in ACE's case, the same kind of philosophy of anything can be tokenized, but it needs to be something real, and there needs to be some reality to it. And Lars, you have probably transitioned in this time period that we've been speaking from purely a digital banking solution, which was meant for brick and mortar, and you were talking about bridging into the next step to having created the entire integrated platform. So, and I think that's probably the future, right? Is that what we're looking at is really the convergence here. So with that, I'm going to say thank you very much. This was a very interesting panel, and I think we've learned a lot, and appreciate everybody's time. And we will do a follow-on to this panel for sure. So
Thank you all.
have a wonderful day.
Thanks.